Hi traders, welcome to this edition of Market Outlook Trends, Risk Events and Trade Setups brought to you by Vantage Markets. This is a weekly webinar where we focus on the key events and themes, both technically and fundamentally driving markets at the moment. Whilst I just let you have a look at the disclaimer, I'll just run through what we hope to get through this week. As usual, we'll check out the markets currently, how they're shaping up for the week ahead. We'll look at a couple of things actually in more detail. Obviously, we've seen this Fed pushback from various speakers over the last week, which we highlighted actually last Monday to look out for. And we've certainly seen that slight pushback in their rhetoric against this, obviously the softer US CPI data that we saw and the Fed pivot idea. There's certainly more work to do, it would seem, and we'll look at that, go into some of the depth in that, and also just a brief look at yield curve, actually, and yield curve inversion. We mentioned it in our daily commentary. We think it's worthwhile just to dive a little bit into that. We won't use too much technical jargon, if you like, but certainly worth looking at that idea as a whole, and then really you could base your ideas, some of your trading ideas potentially off this kind of analysis and looking at the yield curve, as I say, not in too much depth, hopefully, and hopefully you can understand it. Obviously, if you do have questions, then please do ask away. We'll then look at the dollar, of course, the DXY technically, and we'll look at some of these stock indices as well as then we normally look at gold, and we'll actually look at oil today as well briefly, because that is obviously tanking, selling off quite sharply over the last week or so. So worth just having a look at the ideas and the themes behind this sell-off and some of the technicals as well. We'll then preview some of the events of this week. Not a lot of data on the calendar, but there's the RBNZ meeting on Wednesday. And also we have some quite important Eurozone data out on Wednesday as well, actually. So we'll look at the Kiwi dollar and the Euro dollar as well. Hopefully you are all, tuned in. Certainly it's been another eventful week, really. Markets at the moment, well, there's fairly sluggish start to the week. Choppy few sessions last week, really. US futures are pointing to a lower open on Wall Street, actually, after we saw some doji candles printed on the weekly charts for the S&P 500 and the NASDAQ. Just bear with me 1 second. It's just a question about the Fed, just how much the market is pricing and the plausibility of a 50 basis point hike ahead of the last meeting of the year. Okay, we'll get to that for sure. Always good to have your questions. I'll pull up the CME Fed Watch tool, which we've used consistently. Most webinars actually that we look at, that's the Fed Funds Futures and what they're thinking. I'll pull that one up for you, no problem. And we'll take a look at the pricing for December and also then further out. I'll get to all of that. Certainly we are moving the Fed funds peak rate, if you like, that terminal rate is closer to 5% now, having dropped to sort of 4.8% or so after the US CPI data, that softer data, seeing the peak rate go lower. But now with this Fed pushback, the Fed rhetoric, the hawkish rhetoric that we're seeing, and certainly we are pricing in still only probably a 50 basis point hike actually in December. But remember, it's this theme about rates going higher but further out. So it's not about the size of the rate hikes really, but it's about this peak rate now, and I'll get to all of that hopefully fairly quickly. Just looking at markets then, as I say, we questioned last week how long this kind of positive feedback loop, we called it, would last. That loop really being US inflation lower, the China reopening, of course, that we slightly got excited about, or some in the market did for sure. We kind of questioned it last week, and then also this potential war de-escalation. But certainly in China, especially today, over the weekend, it seems the recent outbreak of COVID in some cities is still prompting restrictive measures. Reports actually of the first official COVID deaths in months, actually. I think on Sunday, there were reports of that, and really sort of pointed to the zero COVID policy, not especially undergoing any major change, it would seem. The Hang Seng, if you guys look at that, that was down 5% at one point, I think, overnight, with the region said to be near cutting non-emergency services and public holidays amid a surge in COVID cases. So worries about China, certainly, although equities were higher on Friday, lifted by pretty much a ramp actually into the close. I think I read it was a hefty buy side market on close order imbalance essentially, and that lifted the S&P certainly into the close, and that was lightly influenced actually by options expiring actually. But we see the VIX, so that's the volatility index, that's still around 24, I think. Last time I looked, 23.97. So above that long-term average, which is around 20 or so, just below. So that kind of reflects, you know, this continued uncertainty in the growth outlook. Regarding inflation and the Fed, recent comments from Fed officials have suggested that that terminal rate views are sort of coalescing, if you like, around a sort of 5% point or so, sort of nice round number, if you like. As I said, up from the 4.8% post the US CPI data. Markets kind of pricing in that. In fact, just before we've got this graphic, obviously, with the rebound in the dollar. Let's just go to the CME Fed Watch tool that we've been asked about, and for sure you can see, yeah, just as coalescing, as I said, around the 5% mark. But before we get that, of course, you see the 14th of December meeting now. Hopefully you can all see that. And we have an 80% chance of a 50 basis point hike there. So 80-20, really, 20%, 75 basis point move. That would be the fifth straight move, remember, kind of unprecedented. But really, markets banking on just a 50 basis point move in December. I always use the marker of a 70% chance. So anything above that going into the meeting, just before the meeting, the Fed really don't like to shock too much market pricing. So yeah, we still have a couple of weeks or so actually before obviously the mid-December, 14th of December Fed meeting. But at the moment, 80% chance of that happening. And then if we look further out, we can see, yeah, we're sort of pushing into this 5% marker. So a 40% chance of that happening at the 14th of June meeting. If we just scroll down, you can see, yeah, we haven't moved that much. We moved from a month ago from, 27% for the 5% up to 40% now. And then you could see that sort of difference from the 4.75% peak rate. That was given a 42% chance, and that sort of come back to 26% or so. But you remember we sort of used May as the peak rate, and now we're sort of pushing further out slightly to sort of June. If we were to look at this exactly, I think nearer to June is now the peak rate. But near term, yeah, 80% chance of this 50 basis point rate hike in December. But just going back to the Fed speakers, then certainly some variation of certainly around how many speakers there were, but the sort of take-home point really Fed messaging was that policy needs to remain restrictive for some time. We've not seen this cycle's peak for the Fed funds rate. And arguably kind of this cautious attitude really towards the outlook is being seen really revealed because we're yet to see a succession of weaker CPI prints. Remember, just the sort of most recent one, and the labour market is still historically tight. And really kind of think until that slack increases, then the Fed, the FOMC will want to keep financial conditions tight. And that requires the market really will remain focused on these upside risks to policy. I think a good example of recent Fed speak was Boston Fed Collins, who joined. She joined really this chorus of officials trying to reshape market expectations, which they're kind of doing, as we've pointed out here. She said rates need to rise further and even kept the possibility of a 75 basis point move on the table, interestingly enough. But then, just as others did, she puts the focus on how rates ultimately need to go, how high rates need to go, instead of the pace, which is obviously what we said earlier. And those comments certainly helped the dollar to recoup some of the losses endured earlier last week. Really then, Fed officials continue to suggest there's more work to do, ensure the inflation fight or the inflation battle is won, if you like. And really will continue to hear these comments suggesting this risk of probably doing too little outweighs the consequences of doing too much in terms of these rate increases. And there are more Fed officials speaking this week, so keep your ears and eyes open for those on the wires and reading about those for sure and whether they continue this same theme. Just looking at the dollar, I'll just go back to that. This graphic obviously that we've seen, you can see this rebound against some of its peers from the lows recently. Certainly sterling sticking out obviously from that spike low down at 103.50 or so. Big rebound since those lows, but across the board really, euro, yen, franc as well, the Swiss franc. And then you've got the Canadian dollar there, much less so, and driven by slight pullback in risk sentiment, of course, but also by oil. And that's why I think it's worth spending a little bit of time on that. But regarding the dollar, interesting, some or more questions about whether we've seen this peak in the US dollar. It's fallen over 4%. Versus the basket of 6 peers that we look at in the DXY, that is, so down over 4% this month. And that leaves it on track for the biggest monthly fall since September 2010. Though, let's remember, it's still up around 11% year to date as a whole. So currently it's kind of firm today, up 0.8% or so today, actually, trading on risk sentiment at the moment then, and these safe haven flows down to the China story really. And we can't forget that's an important driver for the dollar, safe haven flows, and something to really just remind ourselves of going forward. Probably a couple of things to highlight then that I've mentioned, aside from data watching. There's not a lot of data this week. Durable goods, the FOMC meeting minutes we'll touch upon, but the major reports will be in December. The 2nd of December is the non-farm payroll reports. And then we have this massive week in the middle of December, just to highlight. We get the November CPI print on the 13th of December, the Tuesday, and that's ahead of then the FOMC meeting the following day. And then we actually get the Bank of England and the ECB on that Thursday, the 15th, I think, of December. So a massive week to take us into Christmas and the New Year. And then, of course, January. Just looking at then this idea around yields. Don't want to go into it in too much detail, but we've seen this rise in short-term treasury yields, and that's really accentuated this US curve inversion. And that's where markets now are pricing in this idea as well of a 2023 recession. We touched on this, as I said, in the daily commentary, but the idea of inversion, yield curve inversion, is important because it's previous ones have preceded every US recession for the past half century. And these inversions, these yield curve inversions, they typically indicate that investors think high interest rates will crimp economic growth. I should add a major caveat to that is that these inversions, they don't tell us the timing of that recession. Historically, it tends to follow a year after the inversion, but the variance is large. It could be up to 2 years away, and there are occasional false positives. But generally, yeah, yield curve in itself, that's a chart that shows interest rates that buyers of government debt demand in order to lend their money over various periods of time. And a lot of concentration on the US yield curve. That's obviously due to the central position of the dollar in the global financial system. But that kind of, the US yield curve acts as a kind of gauge, a barometer about the future path of the world's biggest economy, and really has a strong record in signaling downturns before they arrive. I'll just pull up this chart here. Again, don't want to get bogged down too much, but the yield curve generally, a normal yield curve, that's the yellow line, is upwardly sloping. As if you think about it, higher fixed rate of return is earned from lending money for longer periods of time. And most commonly then is looked at is the shorter duration 2-year yield. That moves most closely with Fed interest rate expectations. And then you compare that with the yield on the 10-year treasury. That's the most widely quoted treasury yield. And that really represents investors' best guess at where inflation growth and interest rates are headed, obviously over the sort of further out, so the medium term to the long term. So the yield curve tends to flatten when investors expect a slowdown. And really, at the moment, the focus is on this 2-year to 10-year yield curve, basically. That's under the spotlight because it hit actually minus 0.71% last week, and that's the widest level since 2000, in fact. And even actually looking at the yield curves across the board, I think more than 70% of the US yield curves are now inverted, and that's the highest since late 2006. So what does this all mean? For the dollar, really, history suggests that it does not usually fare all that well in the early stages of US recessions. Pretty logical. And economic headwinds, really, they keep the dollar tone more defensive, really. And that's potentially, obviously, what the market is looking at and what we've seen over the last few weeks. Just got another question here, just about the strong possibility of recession next year. Is there any indicator that the US's GDP has been lower than expectations for 2 quarters? Well, not yet. And this is the issue, I guess, is I don't have a chart, but obviously we still have a very strong, really a relatively strong US labor market. And this is probably the issue with forecasting further out. And as I say, these caveats around yield curve inversion pointing to a recession. The technical definition, as you say, is for 2 quarters of negative growth. The yield curve is only forecasting that in the future, so it's a good predictor. But as I say, the timing of that is variable, and really, especially when yield curve inversion gets lots of headlines and recession is imminent, that is not the case, really. History tells us that, as I say, a year out, potentially up to 2 years out. So at the moment, no indications GDP is there yet, but as I say, because of primarily because of the strong labour market, and this is what we try to show. I don't have the graphic with me, but just this relatively still strong non-farm payrolls reports that we get, strong growth monthly, although it is declining, even 200,000 per month that we're down to sort of 250 or so, is still relatively strong, still buoyant, and that's keeping wages 0.3% or so, obviously down from the 0.6 recently. But as we get strong wages, a strong, relatively strong still labour market, then potentially that recession is pushed further out slightly. I hope that answers your question. But yes, for the dollar then, yeah, doesn't fare that well in the early stages of US recessions. And obviously then if we get these headwinds coming slowly but surely, and we get potentially then weaker GDP growth, then potentially that gives us a more defensive tone on the dollar moving into the first quarter of next year. One other area I think is worth looking at is this position adjustment idea that we've seen in the recent weeks, and especially some of the sharper moves that we saw obviously in the dollar over the last week or so, or the sell-off in the dollar was due to this position adjustment. And we could see that in basically traders trimming their bets on the stronger dollar. Those bets are now at the lowest level in a year, and in fact, on some measures, actually, we've had the first net short in the dollar since early 2021. All this information that's derived from a report that's published by the CFTC, so the Commodity Futures Trading Commission report. They publish a weekly report called the Commitment of Traders report every Friday, and that basically aggregates or takes the net long and short positions taken by futures traders across the board, so speculative traders and commercial traders, and really it's a gauge of how big market players are positioned in the markets. So that's hedge funds, retail traders, of course, banks, but then also, as I say, commercial traders, so big companies who take FX positions in the futures markets. And really, we can kind of use this report sometimes to foresee incoming changes in market sentiment. And at the same time, it can also be quite an interesting reversal indicator as well, so a contrarian type indicator. And at the moment, as I say, potentially the first net short in the dollar since early 2021. And that's all against, or a lot of it is driven by the euro. The euro has been the major driver probably of sentiment and positioning versus the dollar, actually. And last week saw the biggest bullish bet in the euro since June 2021. So again, just another sort of thing in our armory, really, to look at for us, really, and driving some of the dollar moves recently. And then obviously the dollar moves, then we look at all the other currencies and those other major pairs, which then will move on the back of this. Okay, just back to sort of markets in general then in the coming week. Obviously it's Thanksgiving, so it means a holiday shortened week in the US. Thursday's Thanksgiving, but the focus really still around the outlook for Fed policy. We do get, as I said, the release of the minutes from the 2nd of November Fed meeting. If you cast your mind back, that was reasonably hawkish, although we did get that U-turn, if you remember, intra-meeting, if you like, where we had those dovish tweaks in the statement language, which everybody got excited about, gave a big boost to stocks, and the dollar fell. And then we all switched around during the meeting when Powell started, and really it was those changes that he highlighted, sorry, not those changes that he highlighted, sorry, but really he wanted to shift the narrative from, as I say, the size of the rate hikes to the peak terminal rate. So if we get any talk around officials in the minutes wanting to take their time after a lot of tightening already, then potentially the dollar correction may struggle that we're seeing recently. The flip side, we see a Fed still strongly determined to beat inflation. and so raising rates higher eventually, and that would certainly give the dollar, you would think, a bid to it. Let's just look at the DXY now that we can see here. So we can see technically then we sort of got we've got a couple of levels here, a few levels. We've got the 200-day moving average. This is on the DXY. Remember this basket of 6 currencies, essentially against the euros, the biggest weighting by far, 57% or so. Always bear that in mind when we look at the DXY. But yes, we've got the 200-day moving average, 104.63. No, 105. 11, sorry, is a 200-day moving average, but I've also got these highs here, 105.78, and then also sort of some support there around 105.11. We didn't quite get there last week, dropped to 105.34, and then found some a base of support really just above that level, 105.78, and we're pushing up. But we do obviously have this strong resistance now from really this trend line support, which turns resistance in amongst a couple of simple moving averages there, the 100-day and the actually the 21-day, these two averages, but around sort of 109.18 up to 109.46 or so. So interesting level of resistance if we do push on above there this week. And especially markets look potentially to the FOMC minutes on out on Wednesday evening UK time. For stocks then, we like to look at stocks technically as well. Let's look at the S&P 500. Just bear with me 1 second. I'll just pull up the weekly actually. Which looks very confusing, but I'm only pulling up the weekly so you can see that candle. You can see it's a doji candle. And that basically represents indecision between buyers and sellers. You can see that the open and the close is pretty much similar, very similar. So you kind of got a neutral outlook really at the moment. Indecision, as I said, between buyers and sellers. That's kind of what a doji candle represents there. And then let's just pull back to the daily. We can see obviously the big bounce, 40% or so since the lows in October, below 3,500. And then we've sort of struggled with the 4,000 level, key psychological level for sure. We've got a sort of near-term fib level just above there as well, of this August sort of down move. Fib level, yeah, near-term fib level around the 4,000 level as well, reinforcing that. But we've got the 200-day moving average widely watched, and then that trend line resistance just above 4,000, 4,067, the 200-day moving average to watch out for. And then support, well, we've got the 100-day moving average actually capped the downside on Friday. You can see at 39.10, and then below that, we're sort of getting into sort of 3,800, 3,860 or so. So potentially we just track sideways, not too much data, as we've said, and markets kind of zeroing in on Fed officials, Fed speak, and then certainly as well the big start of the month, next month, with non-farm payroll, of course. Okay. Other technicals, just to briefly look at NASDAQ, you can see the 100-day moving average capped the upside 11,981 there, and we're kind of now on a fib level 160, no, sorry, 11,693, sorry. Sort of offering some support. Again, if you look at the weekly, you can see that doji candle, so a little bit of indecision. For the Dow, let's just pull up the Dow chart. Obviously, we've highlighted this in the last few weeks about the outperformance of old economy value stocks, if you like, and this big bounce around 18%, I think, or so. Key level is that August high at 34,281 in the Dow for us. But this kind of potentially, if we can break through last week's highs, then certainly sort of bullish consolidation pattern here. Otherwise, support at, well, Friday's low, 33,239 potentially, and then we get a couple of moving averages that you can see here as potential support. I'll just look at the DAX actually briefly, which is here. You can see again sort of consolidation at the highs, big moves around 21% actually from these lows in the DAX. This is a German index, so bull market territory, I guess, above 20%. And potentially, just pulling that back, you can see the June high is a target for bulls at 14,709 potentially, if this is sort of a bullish consolidation pattern. Just bear with me 1 sec. Just saying, do we trade stocks on Vantage as well? Certainly we do. Single stocks, a lot of the major single stocks in the US and elsewhere, as well as indices, which is why obviously we're going through the major ones in the US as well as the DAX, which I know is a very popular index to trade. So certainly we trade single stocks and stock indices at Vantage. Okay, that is the DAX. Let's just now get into what else is happening this week, I guess. In fact, I'll just go to gold now as well. I know, very popular. Gold, you can see this chart trades lower then for a 4th day now for gold. Market potentially targeting 1725 we've got here as support. The drivers here then, the stronger dollar, obviously, with this slightly more hawkish rhetoric by Fed officials is weighing on prices. We also know actually that gold futures were bought at the fastest pace since June 2019 during a 2-week period up to November 15, and also into the run-up to last week's failed bid to break resistance around 1800. So potentially, if we see long liquidation from some of these funds, then potentially we get this downside and more downside to come. So that's something to bear in mind. Also, during the same period, holdings in bullion-backed ETFs, they continue to drop. So that really kind of doesn't signal much appetite from longer-term focused investors to get involved really in this uptick, in this uptrend that we've seen. Just a couple of things then as gold drivers, an extension of the recent rally that's likely to require then further declines in US Treasury yields, and then the US dollar would then also turn lower, potentially driving fresh demand for ETFs, or potentially on the bull side, then we'd need a sort of run to safety, if you like, and gold buying because of that. But technically, yeah, upside capped by the 200-day moving average 1801, and then we've got this level of support around 1725, which are a couple of fib levels actually that we've got in here for gold. Okay, I said I'd look at oil as well. We've seen a lot of downside in the last week or so, and certainly oil prices look as though they've rolled over. Mounting fears about weakening fuel demand in China, of course, and they're outweighing concerns that Russian supply could fall next month when these tighter EU sanctions on its crude exports come into force. In fact, I'll just pull up WTI. So that's the US benchmark, crude benchmark, if you like. That lost around 10% last week. That was its biggest loss since March. Major support sits at the September low that we can see here at 76.28. If we just then pull up the Brent crude chart, that's really the international benchmark, really, if you like. That dropped around 9% last week. Lost over 2% on Friday, and we're sort of down over 0.5% today. Just pulling back from its lows it did on Friday and today. In fact, the cycle low, that September low, comes in at 82.46, so a key level there to look out for on the downside. I think recently as well, the IEA, so that's the International Energy Agency, they cited quite a few headwinds coming up for oil demand, including certainly the China story and its persistently weak economy. Also, they cited the energy crisis in Europe, of course, and then rising recession risks really across the globe, really, as well as obviously dollar strength that we've seen previous to the last week or so. This actually led them to cut its forecast for global oil consumption next year. So something to bear in mind for oil, if you guys look at that, and potentially that big level of support in that September low on Brent, around 82.46. Okay, for this week then, we have the RBNZ actually, and then also to look out for is the Eurozone PMI reports. We'll just run through those briefly. First of all, Kiwi dollar. Yes, and the RBNZ. It is widely expected, actually, the bank to raise its cash rate again at its upcoming meeting on Wednesday, that is. I think 15 out of 23 analysts polled by Reuters, they forecast a 75 basis point move. That would take the cash rate to 4.25%. The other analysts, they lean towards a 50 basis point move. Just recapping, at its last meeting in October, the RBNZ, they reported that it did consider a 50 basis point or a 75 basis point hike, given the inflation challenge. In the end, it just chose a 75 basis point move. However, since then, both the market and the RBNZ have been surprised to the upside on a range of key data. So notably, we've had inflation stronger. Headline CPI rose to 7.2% year on year, core 5.4%. So that's way above the bank's target of 1 to 3%. Food price inflation rose to a new record high. Inflation expectations, they also rose as well. So kind of undoing a decline in the prior quarters that we saw in inflation expectations. And then employment, that's also grown, and key wage measures have risen as well. I think as much over 7% year on year. So still signals a tight labour market. The bank will be very focused on that. And in this employment remaining strong, really, the picture in New Zealand. The bank's also set to publish its updated forecasts. And I think economists think they're likely to raise its projection for the peak cash rate from its previous forecast of 4.1% in the middle of next year. Overall, then, the bank sort of is proven that it's not really afraid to go on its own, if you like, even with this global tilt towards slightly slower hikes in the near term. I think local investment banks, that is, they predict the cash rate going to 5%. So that would be another 75 basis point hike, possibly in February, if they do 75 basis points this time around to 4.25%. And really, then that's kind of a done, let's get it done attitude, if you like. I think one bank sort of highlighted it as being taking the cash rate to 5%. And then if data cools more rapidly than expected, then they could well slow the pace of their hikes at that point, so February next year. Just got another question actually come in again. Great to have these questions. Let me just read this one. Yeah, just about going into the end of year holiday season, whether stocks are going to perform better. We did look at this last week. If hopefully some of you remember, we had the seasonal chart, which pointed to generally stocks performing quite well into year end, into the holiday season. So whether that continues, again, there's a lot to evaluate, and I think that's kind of why I highlighted what we're going to see in mid-December. We've not really had that in previous, just thinking from memory, so many key risk events in a short space of time just before the end of year holiday season, really. So I think we've obviously had a big run up in stocks already. You know, as I've pointed out, the Dow up 18%, the DAX up 21% from these lows. So potentially, I would say big funds, banks will be taking risk off before those risk events, if you like, in mid-December. And that is really something to bear in mind. That means we might have less liquidity, which means we'll get more volatile markets essentially into the holiday period. Is probably our thinking at the moment, and especially as we've seen some big moves already from those lows, then yes, whether history repeats itself with the seasonality and stocks moving higher, we will see, and certainly we'll try and cover that in the next few months. In the next few weeks. I don't want to dodge the question there, but hopefully it's just given you some sort of scenarios to think about. Yes, just back to the Kiwi dollar then. Again, big bounce in this pair, around 11-12%, I think, from the lows, the Kiwi. Those lows at 55.12, I think, so below 56. And we've sort of got up again to consolidation, really, potentially bullish consolidation. So if we can break probably last Friday's high there at 62.06, then potentially we move up to, again, the 200-day moving average around just above 63 that you can see there. If we do get this hawkish tone sort of continued by the RBNZ, and certainly a 75 basis point hike as well, because not everybody is convinced we will get that. Okay, that's the Kiwi dollar. Then finally, let's just look at Eurozone PMIs. I've got a chart in here actually just showing you Fed policy actually that you can see there. I'll probably use that in the weeks to come. Actually, you can see that potentially if we do get to around 5% in the Fed funds peak rate, then that would be the most in 4 decades or so that we've seen the most tightening in this period, in such a short period, for over 4 decades. Yes, just over to Eurozone PMIs. PMI data, that's survey data released midweek across Europe, across the globe actually, but Europe tends to be the one that we traders mainly focus on. The prior figures for Europe in October indicated economic activity slowed further, so markets will be keen really to assess this. PMIs are basically a health check, if you like, on manufacturing, on services sectors, and certainly with an eye to the outlook next year. There are potentially some signs of good news with easing supply chain pressures and prices, and certainly that would be seized upon. But forecasts are for both surveys, actually, manufacturing and services, to fall. I think manufacturing falling from 42.46 actually from 46.4, and services falling to 48 from 48.6. And you can see here, anything below this 50 line denotes contraction. So we're still in contractionary territory on that sort of orangey line. That's the composite numbers, if you like. So combining manufacturing and services. So below 50, still in contractionary territory, which is pointing really to a winter recession in the Eurozone economy. There isn't a lot of other major news actually to shift the economic narrative. Actually, inflation is still high, 10.6% in October. So expectations, as I say, for economic conditions to remain pretty weak. Regarding the ECB then, policy perspective, well, the December meeting, a lot of traders have now focused on, of course, increasingly likely that the policymakers do step down from that 75 basis point hike to a 50 basis point increment. That is what it is expected at the moment by the ECB. Hawkish policymakers there, not really doing a lot to talk up a bigger 75 basis point move and back up what they did previously. So it will be interesting to see, obviously, this health check, as I've said, in Eurozone PMIs as a pointer to potentially what happens there. And then in euro dollar, let's just pull up that chart. You can see we just sort of rolled over, interestingly, from sort of above 103.86 or so, that level we had there from the August high. We couldn't sustain that level. And you can see that the 200-day moving average really capped that upside. That's at 104.06 now. So potentially we're rolling over here. Next level of support really would probably be these September highs around just below 102. That would probably be our next level of support there before we get to these simple moving averages. Yes, we've also got a just pulling up the weekly, just looking at this fib level here. This is of the this year's downtrend, actually. So you have a fib level that we've just sort of broken through there, a 102.84. So that might be a sign, yes, that we've got more downside to come. That would be more upside in the dollar potentially. Okay, I think we've covered a lot as usual. Hopefully that's been helpful for you guys. Sort of not that much on the sort of data front, but potentially these Fed speakers again to look at, and then the Fed minutes potentially, if that shows that the Fed is still determined in their inflation battle, then certainly that could underpin support for the dollar and see euro dollar and cable potentially also rolling over. Please follow us on social media and on our website, our daily commentary, and we look forward to speaking to you next week. All the best.